Welcome, you're on The Fringe Show. I'm your host, Tatiana Zalan, and I go live every Friday at 2 p.m. Dubai time. Last week, I couldn't be online because I couldn't be with you because we had some internet connection issues. So what we're doing here with The Fringe helps you to understand the rapidly changing world and navigate it and increase the odds of your success so that you too can take advantage of the opportunities in the new digital world. Here we discuss technology, startups, and mental models of successful people. Today, I'm going to talk about DeFi, which is a very interesting topic. DeFi stands for decentralized finance, and how we can reimagine or reinvent, if you will, the whole financial system. The term DeFi refers to decentralized finance. It's an alternative financial system that's currently being built, mainly on Ethereum, but there are also other projects that are working on different blockchains. It's a huge topic, and today we're just really scratching the surface. What we're doing today is an introduction to DeFi, and what I will do in the subsequent shows, I will try to have a look at, say, for example, topics like how can I participate in DeFi, depending on my risk profile, depending on whether I'm knowledgeable about cryptocurrencies or not, and so on. So what we can do. But today we're just having a very introductory talk about what this is all about, and that's what we are going to talk about. Things like what's wrong with the current financial system, what is DeFi, how we can think about it, what are some of the differences between DeFi and traditional finance, and also some of the examples of innovations and interesting projects that are currently happening on DeFi. And probably in the next show, as I mentioned already, I'll think about something like what can I do on DeFi right now if I want to participate in this very exciting ecosystem. It's a live show, just a reminder, and so please allow Facebook and StreamYard to identify yourself, and please comment, ask questions as we go along. I think one of the best places to start is to say, well, what are the problems with the traditional financial infrastructure? Firstly, it's centralized, and this centralization comes at many, many different levels and layers. Whereas single bank controls interest rates, it controls fees and influences the rate of inflation. Switching between banks for us as users can be actually very costly, and the banking system itself is very highly concentrated. In Australia, where I'm from, there are only 4 major banks, and there would have been 2 had it not been for the so-called 4-pillar policy. So very concentrated, and that's not unique to Australia. It's also very characteristic of other countries. Now, we are in 2021, and yet 1.7 billion people are still unbanked. So it's really difficult to obtain loans for this part of the population. You cannot participate possibly in e-commerce because you don't have a bank account. Small businesses have a particularly hard time to apply for loans because big boys are not interested, the banks are not interested in small loans. And even in the US, if you think about it, 6% of the population is unbanked. I now live in Dubai, and the GCC region is a slightly different story. But in the MENA, the Middle East and Northern Africa, the percentage of unbanked people is almost 70%. So limited access. Inefficiency. If you go and do something with your credit cards, it's obviously it will be charged about 3%, and that's a loss of value for both customers like myself and for the small merchants as well. If you look at the remittances, it's anything between 5 to 7% on the average, and some point in time, Western Union, I clearly remember that, was charging 15% of the transaction fee. It takes 2 days to settle your, at any transaction, 2 days, and we live in 2021, and we have the internet functioning as well. Microtransactions are not at all possible. Nobody is interested if you have $1, $2 to send overseas. Lack of interconnectivity. I'm sure if you're dealing with international banks or selling money abroad, you will know that it may take up to 3 days and sometimes a lot longer. Interconnectivity is an issue clearly as well. Lack of transparency. We bank customers have very little information about the bank. It's not very easy for us to see what's the market for loans. Not easy to discover what's a good rate, what's not, because this market is clearly very fragmented. It's I would say that fintech companies have improved on that a little bit, but we're still pretty much there. So the bottom line, what's the bottom line of all these inefficiencies? It's slower economic growth, and it's also limited opportunities for people, for many billions of us living on this planet, that's still not having access to banking. You can ask a question, okay, where does DeFi coming from? Well, the origins of DeFi are actually in fintech. So all of the modern DeFi projects can be traced back one way or another in terms of the way we think about finance is to companies like PayPal, and now Stripe is very big, of course. But there is one problem with fintech, so-called. It's all built on traditional legacy infrastructure. So if you look at the amount of money that went into decentralized, rather not decentralized finance, but into fintech and all fintech projects in the last decade or so, and it's been in the dozens of and hundreds even of billions of dollars. What it went to is kind of the product of that. The return on that money isn't really very impressive, because what was funded was user experience on mobile. Yes, it changed the distribution, but it didn't change the product itself. So we got Robinhood, we got Evolut, but do we have anything else? So what's the big deal here? Well, with the existing financial stack, what it's doing, it's really supporting what we call network effects of the traditional legacy system, which is why it's so difficult to get uprooted, if you will. And it's in no way disruptive. All these innovations in fintech that we see happening are in kind of incremental improvements. It's all about user experience. It's great progress, but it's not solving the main problem. And here where DeFi comes. So what is DeFi? It's an alternative to this inefficient, traditional, siloed financial system. It provides minimum friction for the user with maximum value for users. And it's as much as a movement as a collection of different applications, decentralized applications and other tools. Traditional finance relies on intermediaries to manage the process of financial services, while DeFi operates in a decentralized environment. It's public, it's permissionless blockchains, services are generally encoded in open source software protocols and supported by smart contracts. It solves the problem of traditional finance because we have a shared infrastructure and interface, and gives us a radical interoperability between the various pieces of the system, and it's not achievable in the traditional legacy system. How did DeFi evolve? Let's have a look a little bit at the history. Well, it all started, of course, with Bitcoin blockchain, Bitcoin in itself. Then Ethereum came onto the scene around 2014 with smart contracts, programmable money, and interactions between data and assets. Then we had a quite crazy period of ICOs, initial coin offerings, in about 2017, where there was a lot of craze. Most of them, and many of them, not most of them, but many of them were certainly scammy projects, and others were simply not very good projects. However, there was one thing for which we need to thank ICOs, and that was a major innovation in early stage capital formation. Then came in DeFi, and some analysts would argue that in future, maybe all financial services will be decentralized. So that's looking to the future. What we have now with DeFi, and that's another way of looking at it, is we have a complete prototype of an existing financial system, and more products and services are coming almost every day. It's a very dynamic field, and you can almost use crypto as a test net for the off-chain, for the traditional world, if you wish. It's fundamentally and structurally different from the legacy system because it's peer-to-peer. It's like an old barter system. You can think about it that way. We're coming almost like full circle of being much of the commerce and transactions being peer-to-peer, and plus it is open source. What can you do now on DeFi? Many things. You can buy, you can pay, lend, you can borrow, you can trade, you can invest, you can margin trade, you can govern, you can hedge, you can bet. A lot of things are available. Even insurance is available on DeFi as well. The size of DeFi is interesting because it's a very small, still very small market. DeFi in itself started around 2019, 2020. So it's really, really very early. If you want to participate it, that's the time to think about it and maybe get yourself a bit more familiar with the ecosystem. It's only the total value locked, and one of the criteria and the measures of the size of the market, it's only $55 billion. So it's quite small at this point in time. Let me talk a little bit about DeFi building blocks and technologies. What are the technologies that are underpinning DeFi? Blockchains themselves, distributed ledger technology, they're the settlement layer for transactions, and it's mostly on Ethereum, as I said, because it's of capabilities and the smart contract capabilities in particular. And there are lots of developers working on Ethereum and on DeFi and Ethereum as well. Then there are digital assets. There are all sorts of tokens representing value. They can be traded or maybe transferred within a blockchain network. Then there are wallets, and wallets is something, it's a software program, sometimes it's physical device as well, that allows us as users, as owners of cryptocurrency, to see what's on blockchain, because all of your assets are, of course, stored on blockchain. So it's mutable, it's there, it sits there. You need somehow to see how to connect with all these assets, and that's what wallets allow you to do. Then we have smart contracts. It's really software code that carries out and controls and documents all these various events and transactions that might happen on blockchain according to predetermined rules. Decentralized applications, that sometimes referred as dApps. These are software applications built on smart contracts or out of small contracts, and very often integrated with user-facing interfaces using traditional web technology. Then there are governance systems, and this is something that's not possible for us as users in the traditional system, because it allows us to have a say in the rules and the procedures, in the code of the protocol that we are supporting. So if the token has got governance rights, then we can have a say, for example, how much we should be issued of this or that token. Something we don't have in the traditional finance as users. Then there are decentralized autonomous organizations. I mentioned them a few times in my shows, and they're entities whose rules are defined and enforced in the form of smart contracts. It's not people governing all these sort of organizations, but it's actually governed by code, by smart contract. Stable coins, I will be talking about stable coins today because it's a major innovation as well. And these are digital assets that are pegged usually to a fiat currency, but they can be pegged to another valuable assets like gold and stocks even. And oracles are probably one of the last things that we need to mention. Oracles allow you to interface from DeFi with the real world in that dynamic fashion. For DeFi to function, for example, for exchanges to function, you need to have dynamic view, dynamic picture of, say, the current price of a stock of fiat currency. So oracles are programs that allow you to connect with the traditional world in that fashion. Let me talk a little bit about the innovations on DeFi, and there are plenty, and I'm sure you haven't even heard about those type of very fancy words like atomic swaps, autonomous liquidity pools, decentralized stable coins, flash loans. They're very, very new things, new projects, new tools, and they're just some of the few examples to show you how explosive the growth in the system has been so far. We'll start with automatic market makers. What are they? Well, it's something that's related to how decentralized exchanges operate. In a traditional system with traditional exchanges, but also with some decentralized exchanges, you have the so-called order book matching process. And it's a system that allows all parties to the exchange to trade only if they agree on the swap exchange rate. So market makers can post bids, they can post asks to decentralized exchange and allow takers to fill in the quotes at the pre-agreed price. So this order matching process, that way it operates, is very cumbersome, it's expensive, and it's inefficient because both counterparties must be able and willing to exchange at the agreed upon rate for the trade to execute. And here where automatic market makers enter, projects like Uniswap and Bancor and Curve. These are just some examples of projects on that use this mechanism. It's supported by rather complex math, but the easiest way of looking at it is like a system that allows exchange of assets using math and smart contracts. It allows digital assets to be traded without permission and automatically by using liquidity pools. We no longer use the market of buyers and sellers, it's liquidity pools. And when other users find a listed price to be acceptable, then they execute a trade and the price becomes their assets market price. The major advantage of that is constant availability. You can execute a trade at any particular point in time. You don't need a traditional counterparty. And the beauty of all that is that the counterparty risk in this kind of environment is zero. It allows also one-sided trading on a contract, which we don't see with traditional order book matching system. So that was a major innovation. Another one is stable coins, and you've heard that before. Maybe if you're just coming into DeFi, you're maybe not sure about it, but those of us who have been in the space for some time would probably say that was actually one tool, one innovation that made DeFi possible. For money to be valuable, it has to perform three functions. It's like economics 101. Money has to be a good medium exchange, a store of value, and also a unit of account. Because of volatility of crypto assets, all of them can't be really a very good unit of account, and sometimes not even medium of exchange, because because of its volatility, we have lots of risks. And if you don't want to have this risk, if you're trading or investing, what you can do, you can convert your other assets into stable coins, because as the name suggests, these coins are stable units of account. I want to give you first one example. You may have heard about Facebook's Diem. They first had it as Libra, but then they changed the name to Diem. And that is their stable coin that they wanted to introduce. I'm not too sure where the project has gone so far. They were having some difficulties there, including with regulators. But this is one of the examples of a stable coin. However, because it has got a custodian, that is a centralized entity like Facebook. It's not part of DeFi. Just wanted to give you this example because it's a well-known project. Now, stable coins can come in many different shapes and sizes. While some of them are fiat collateralized, and that's the largest class. And what it means that they're backed by fiat, some kind of off-chain reserve fiat money of this targeted asset. It's typically custodied by external third party. That third party will have continuous audits to make sure that there is this collateral sitting there. There are a couple of interesting projects right now. One is Tether. It's one of the largest, I think probably it's third largest cryptocurrency right now with very high trading volumes. Another one is USDC, which is backed by Coinbase and Circle. They're centrally controlled, and although we will consider them part of DeFi, they do have a very serious counterparty risk because these companies can just say, we don't want you to trade on our platforms. They can exclude you. So they are centralized. Another variant of that, another type of stable coins are crypto collateralized. These are stable coins which are backed by an over collateralized amount of another crypto. So over collateralization is so high that it kind of wipes away all the volatility that's associated with crypto assets. One of the most popular projects there is MakerDAO and their stable coin DAI. It's backed mostly by Ether and soft peg with economic incentives to for supply and demand to drive the peg to around $1. So it's soft peg to US dollar. And finally, and probably the most interesting class of all these stable coins are the so-called algorithmic stable coins. And one of the most long-standing projects in the space is Ampleforth. They're not collateralized, so there's no collateral. They're not backed by an underlying asset. What they do have is they use algorithmic expansion and contraction of supply to shift the price of the asset to the peg. And to put it in simple terms, if you will, and it's not quite easy to explain it, but the algorithmic stablecoin uses an algorithm underneath which issues more coins when prices increase. So prices increase, there will be more coins. When prices fall down, then some coins, a bulk of them, will be taken off the market. This is what the algorithm does. These stable coins, these types of stable coins operate almost like a central bank, with the exception that the central bank has got lots of other functions, and one of the major functions is, say, for example, funding government spending. But for stable coins, the central banks means pegging the price of the asset. This is what they do. And the third very exciting innovation and development, a tool and application in DeFi are the so-called flash loans. Flash loans are uncollateralized loans. It uniquely exists in DeFi. We don't have equivalents of that in the traditional financial system. With traditional finance, I'm sure you've taken out, probably at least once in your lifetime, you went to a bank to get the loan, so that all this loan is simply an instrument that's designed to allocate capital more efficiently between the lenders, those who want to give you the money, and the borrowers, right? And the lender is compensated with an interest for bearing this risk, and the longer the duration of the loan, the higher the risk and the higher the interest, of course. So what this implies is that short-term loans may be less risky, and a flash loan is an instantaneous loan, as the name suggests, and it's paid within the same transaction. It's almost like similar to an overnight loan in a bank, but the difference here that everything needs to be completed, the loan has to be executed and paid back within one transaction, and this is enforced by smart contract. If this doesn't happen within one transaction, then the transaction will fall apart. There will be nothing happening. Why flash loans are so interesting? Firstly, because they have zero counterparty risk. They're instantaneous. It's an incredible innovation because the user can take advantage of arbitrage opportunities because there are different prices on different exchanges, for example, for different assets, and you can arbitrage these opportunities. You can refinance loans without collateral. That's very, very new. And anyone in the world can access all these types of opportunities. And if you need a substantial amount of money, you can also do that. And again, without collateral, that wouldn't have been possible in the traditional system. It's great for businesses in particular if you want to do that, or great for traders who are confident in what they're doing. I must say that to be able to execute flash loans, you do need to have a bit of tech savviness, so to speak. An average person will probably shouldn't be touching flash loans at the beginning. So I think I will be wrapping up here, and I want to make a couple of comments at the end. Why is it so interesting? Why is it truly transformational? There is a paper which is a great primer on decentralized finance. It's quoted by a number of authors, one practitioner, one independent researcher, and one professor, I suppose, from Duke University, Campbell Harvey, and also from the National Bureau of Economic Research, which was one of the highest research bodies in the United States. So they wrote a very good and very extensive, comprehensive, although a little bit technical primer about DeFi. And I would like to quote what they've said at the end. Now, remember, these are not kind of punks working in the garage. There's a very serious people saying these things. The true potential of DeFi is transformational. Assuming DeFi realizes its potential, the firms that refuse to adapt will be lost and forgotten. All traditional finance firms can and should begin to integrate their services with crypto and DeFi as regulatory environment gains clarity over time. So they're saying that all banks, all the current financial system should be integrating, should be considering decentralized finance. And that's the last sentence. Ultimately, we see DeFi as the greatest opportunity of the coming decade and look forward to the reinvention of finance as we know it. So it's the greatest opportunity in the next decade. We're still very early. As I said, it all started 2019, 2020. So for investors, it's great news. To be able to realize the full potential of it, you really need to be early. And for builders and founders, I also have a message. If you are maybe in the fintech area, you're thinking of building something for the traditional financial system, think again. That's not the future. The future is DeFi. I firmly believe in it. Thank you for joining. Let me see whether we've got any comments. Yeah. Whether I'm seeing any comments here, I don't think to have or to see any comments from you, my listeners. But anyway, thank you for joining. I'll see you on the Fringe show next Friday at 2 p.m. Dubai time. Thank you so much. And of course, now we'll have a little bit of music that I really like.